Welcome to the Debt Crisis Problem Podcast, your source for insights into major risk events that could trigger an economic downturn and debt crisis. Today, we're addressing another key risk, the banking system. Our goal is to create risk awareness and spark a healthy debate for the average citizen. The world is too fragile to wait. We need fresh candor and common sense. A debt crisis looms due to unsustainable debt and deficit spending everywhere. It's time to wake up and speak up. Let's get started. The first quarter 2023 regional banking crisis, has everybody forgot already? The first quarter 2023 regional bank bailout by the Federal Reserve. When Silicon Valley Bank collapsed in March of 2023, as well as Signature Bank, U.S. regulators took action to prevent a banking crisis by backing deposits above the $250,000 FDIC insured threshold at these banks. Noting the fragile banking system, U.S. Treasury Secretary Janet Yellen took additional measures by saying the U.S. government could step in to guarantee deposits at other banks if they posed a threat to the banking system. Quote, "Similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion." Unquote. Yellen's comments suggested that before the U.S. government would act, a bank would have to suffer a run on its deposits, and its failure would have to affect the rest of the banking system. So apparently the smaller banks are no longer important, right? Many bank stocks experienced a sharp decline in value at that time in the first quarter of 2023. Assets at larger regional banks in particular lost value in the rising interest rate environment as existing loans and bonds at low interest rates had embedded losses in them if they had to be sold to raise liquidity to cover deposit withdrawals on bank runs, as investors were looking at assets subject to higher interest rates. Uninsured depositors with deposits above the $250,000 insured level would lose out if their bank failed, as many banks were also at a high risk of bank runs. Banks keep deposits at other banks that are subject to bank runs. So how realistic really is it to have the U.S. government guarantee uninsured deposits at other banks? Or how many banks can be bailed out during bank runs? The commercial real estate market and growing concerns about another regional banking crisis. I found this article by Nicole Goodkind, February 2024. It's entitled, "Wall Street is Worried About Another Regional Banking Crisis." She says, "Wall Street is experiencing a case of deja vu. It's been nearly a year since the collapse of 3 U.S. regional lenders that left financial institutions and regulators scrambling to prevent the spread of a banking crisis. Today, investors are worried they're back on familiar territory. But while the last crisis was all about interest rate risk, this one revolves around the $20 trillion in commercial real estate. What's happening? After decades of growth bolstered by low interest rates and easy credit, commercial real estate has hit a wall. Office and retail property valuations have been falling since the pandemic changed where people live and work and how they shop. The Fed's efforts to fight inflation by raising interest rates have also hurt the credit-dependent industry. That's bad news for regional banks. U.S. banks hold about $2.7 trillion in CRE loans, commercial real estate. The majority of that, about 80%, according to Goldman Sachs economists, is held by smaller regional banks, the ones that the U.S. government hasn't classified as too big to fail. Much of that debt is about to mature, and in a troubled market, regional banks might have problems collecting on those loans. More than $2.2 trillion will come due between now and the end of 2027, according to the data firm TREP. Fears were exacerbated last week when New York Community Bank reported a surprise loss of $252 million last quarter compared to a $172 million profit in the fourth quarter of 2022. The company also reported $552 million in loan losses, a significant increase from $62 million the prior quarter. The increase was driven partly by expected losses on CRE loans, it said. Shares of the bank have plummeted nearly 20% over the past 5 trading sessions and fell an additional 11.2% on Tuesday morning. The regional bank index dropped by about 5.2% over the same period. Of course, New York Community Bank was subsequently bailed out with $1 billion capital injection. Commercial real estate foreclosures jumped 117% in March of 2024 as trouble looms. In an article by Megan Henney in April of 2024, she says, the commercial real estate market is starting to buckle under the weight of higher interest rates and remote work. There were 625 commercial real estate foreclosures in March, up 6% from February and 117% from the same time last year, according to a new report published by the real estate data provider ATTOM. The figure is calculated based on commercial properties with at least one foreclosure filing, including default notices, scheduled auctions, and bank repossessions. They entered that into the ATTOM data warehouse during the month. California had the highest number of commercial foreclosures in March, with 187 properties. While that marked an 8% increase from the previous month, it is a stunning 405% jump from the previous year. California began experiencing a notable rise in commercial foreclosures in November of 2023, surpassing 100 cases and continuing to escalate thereafter. New York, Florida, Texas, and New Jersey now also saw notable increases in commercial foreclosure last month. Foreclosures have steadily risen since May 2020, when they hit a record low of just 141 properties. At that time, the U.S. economy was still in the throes of the COVID-19 pandemic, and many lenders offered commercial loan forbearance to borrowers to help keep them afloat. However, those agreements have largely expired, and now the commercial real estate market is struggling with a number of challenges, including higher interest rates and a waning demand for office space as more companies allow employees to work from home. The Federal Reserve raised interest rates to the highest level since 2001 in response to sky-high inflation. Rates are poised to remain elevated for some time as policymakers have signaled they are not prepared to start reducing rates until they are more confident that inflation has returned to 2%. Of course, there was a half a point drop just recently. About $1.5 trillion in CRE mortgage debt is due by the end of 2025, but steeper borrowing costs coupled with tighter credit conditions and a decline in property values brought on by remote work have increased the risk of default. Roughly $929 billion worth of commercial real estate loans are set to mature this year. Borrowers may have no choice but to refinance with significantly higher interest rates or sell their properties at a steep loss. Complicating the matter is the fact that small and regional banks are the biggest source of credit for the $20 trillion commercial real estate market, holding about 80% of the sector's outstanding debt. Regional banks were at the epicenter of the upheaval within the financial sector last year following the collapse of Silicon Valley Bank, and there are concerns that the turmoil could make lending standards drastically more restrictive. During a credit crunch, banks significantly raised their lending standards, making it difficult for businesses or households to get loans. Borrowers may have to agree to more stringent terms like high interest rates as banks try to reduce the financial risk on their end. Fed Chair Jerome Powell said in March that commercial real estate woes will likely lead to some bank failures, but do not pose a larger threat to the financial system. He said, "We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot," he said while testifying on Capitol Hill. He said, "This is a problem that we'll be working on for years, more, I'm sure. There will be bank failures, but not the big banks." This short ad is sponsored by the TunaBudget.com podcast. Hey friends, looking to improve your personal and family financial wellness? Don't miss the Tuna Budget podcast at TunaBudget.com. Download your free Tuna Budget worksheet plan. the most powerful budget worksheet plan in the world, yours. In addition, dozens of Tuna Budget's human side candid conversation memos may be the perfect answer you're looking for. Join us for real candid conversations and candid questions that can change your life for the better. Subscribe to the TunaBudget.com podcast and empower yourself to take charge of your future and financial well-being. So, is the banking system all better? The banking system risks still exist. Interest rates remain high, which affect the value of bank assets. Banks have in many cases failed to adequately manage interest rate risk by mismatching funding of loans and deposits on their balance sheets. They did not sufficiently match their loans with the costs to fund the loans, primarily from the costs they pay out on their deposits. If depositors feel insecure about their bank via the security of their deposits, they may quickly withdraw their funds. A bank run, in other words, the fleeing deposits, will force the bank to sell its assets, like low interest rate securities and loans, to have sufficient liquidity to cover the deposit outflows. From an accounting perspective, the bank will then have to recognize the loss on sale of the securities and the loans at their lower interest rates. They were originated at the lower interest rates, into a market that has higher interest rates. Those assets are not worth as much in this environment. Their value is worth less than they would yield had the bank carried them to maturity. The lower sales price means the bank will have to recognize massive losses, which depletes their capital, which further increases their risk of failure. This risk creates an environment for more bank runs in the banking system. Furthermore, as depositors want to be repaid they want to be paid higher interest rates on their deposits, they may move them from their current banks to other banks or institutions that offer greater interest. Heavy deposit runoff can add pressure to a bank run, along with a heavy level of adversity risk-rated or classified loans. So the banking system risk most surely exists in the current high interest rate market. Banks are likely soon going to experience downward pressure on their earnings and have a significant effect on their stock prices. As this all unfolds, we must ask ourselves what will happen, maybe not if, but when interest rates spike even more. How many banks could potentially fail during the next crisis? And how many would be sold to other banks, orderly resolution, to avoid a systemic meltdown? Are the biggest banks so systemically important to always get a U.S. government bailout? Are they now supposed to be the safest banks and the other smaller community banks less safe? Are the large banks all only going to keep becoming even larger? It would seem likely that there will soon be a massive consolidation in the banking industry. Well, we can't rely on the U.S. government forever, right? The U.S. government's intention to guarantee uninsured deposits indefinitely is unrealistic at best, which may result in low confidence from uninsured depositors, deposits with balance over $250,000, that are not insured or guaranteed by the U.S. government. How safe and reliable really is the $250,000 deposit insurance during such crises? Banks are now taking measures to reduce their expenses. In other words, they're laying people off, and still generate income in a slow global economy where organic growth is challenged. Meanwhile, with higher interest rates now being paid on deposits, the cost of these deposits used to fund loans is now increasing. This increase pushes the banks to increase the interest rates it charges on its borrowers, which slows down borrowing and hurts borrowers trying to refinance at higher rates. Banks not used to having to pay much on their deposits will likely find their net interest margin becoming squeezed, putting downward pressure on its earnings and impacting their capital levels. The pressure is only going to increase as problem loan borrowers start to manifest from having to pay higher interest rates. Banks will have to increase their allowances for credit losses too, as the potential for loan defaults increases. Many borrowers have yet to realize the higher interest rates they will soon be paying when their loans mature or are refinanced at much higher interest rates. Default risk will increase considerably, and collateral assets can be negatively impacted too. Their values decrease. As all this unfolds, layoffs at banks and the companies they lend to will increase to maintain profitability as much as possible. As this cycle churns, these stresses will likely continue to increase. Even insurance companies need to be concerned about their liquidity positions and whether their illiquid assets may become impaired too. How many more banking shocks can happen before the price tag is too high? The U.S. government can't take care of everyone forever as debt levels keep increasing without going into debt crisis mode. This is interesting. Who is responsible and who is accountable? Let's take a closer look at those bank failures in early 2023. I want to take another deep dive into the accountability of the Silicon Valley Bank failure, $209 billion bank. A sample of the Board of Governors findings. You ready? Silicon Valley Bank failed because of a textbook case of mismanagement by the bank. Its senior leadership failed to manage basic interest rate and liquidity risk. Its board of directors failed to oversee senior leadership and hold them accountable. And Federal Reserve supervisors failed to take forceful enough action, as detailed in the report. Our banking system is sound and resilient with strong capital and liquidity. And in some respects, Silicon Valley Bank was an outlier because of the extent of its highly concentrated business model, interest rate risk, and high level of reliance on uninsured deposits. However, SVB's failure demonstrates that there are weaknesses in regulation and supervision that must also be addressed. Regulatory standards for SVB were too low. The supervision of SVB did not work with sufficient force and urgency, and contagion from the firm's failure posed systemic consequences not contemplated by the Federal Reserve's tailoring net framework. It continues, following SVB's failure, we must strengthen the Federal Reserve supervision and regulation based on what we have learned. This report represents the first step in that process, a self-assessment that takes an unflinching look at the conditions that led to the bank's failure, including the role of the Federal Reserve supervision and regulation. Individuals who were not involved in the supervision of SVB conducted the review, and I oversaw it, says. The four key takeaways of the report are as follows. 1. Silicon Valley Bank's board of directors and management failed to manage their risks. 2. Supervisors did not fully appreciate the extent of the vulnerabilities as Silicon Valley Bank grew in size and complexity. 3. When supervisors did identify vulnerabilities, they did not take sufficient steps to ensure that Silicon Valley banks fixed those problems quickly enough. 4. The board's tailoring approach in response to the Economic Growth Regulatory Relief and Consumer Protection Act and a shift in the stance of supervisory policy impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. Board of Governors System, Michael S. Barr, April 2024. Here's my translation, again having actually worked at the Federal Reserve Bank of San Francisco. I agree that bank management and the board of directors should be held to account. That aside, the Federal Reserve Bank of San Francisco did not take forceful enough action. I wonder why. They had low regulatory standards for this bank. I wonder why. They didn't act with sufficient force and urgency. I wonder why. They didn't fully appreciate the extent of the vulnerabilities as the bank grew in size and complexity. I wonder why. They did not act quickly enough when they realized the bank's vulnerabilities. I wonder why. The Federal Reserve Bank's board tailored approach to shift the stance of supervisory policy impeded effective supervision. Still no excuse. Frankly, Mary Daly's Federal Reserve Bank of San Francisco didn't step up to the plate. Why? There's no doubt in my mind whatsoever that Silicon Valley Bank's CEO, Greg Becker, who also served on the Federal Reserve Bank of San Francisco's board since 2019, where he very much likely played a direct role in financial oversight and decision-making, up through the time Silicon Valley Bank failed in March of 2023, created a relationship that impacted the level of regulatory oversight by the bank supervisors. How could it not? Of course, the bank supervisors would be slow to spot and stop any issues at the bank. Of course, the bank supervisors felt the cozy, or at least must acknowledge it, relationship between Silicon Valley Bank and the Federal Reserve Bank of San Francisco. How could they not? Close ties are close ties, and that raises a lot of questions in my mind about there being a conflict of interest. Lastly, it is unlikely the frontline supervisors, those examiners that are on the front line, are incompetent. They're not. At a large bank like Silicon Valley Bank, seasoned examiners understand risk for the bank's capital, asset quality, management, earnings, liquidity, and interest rate sensitivity. Undoubtedly, in my opinion, there must have been top-down pressures to leave Silicon Valley Bank alone. That's my opinion. And the supervisors, did they cave or did they speak up and get squashed? Somewhere in there is the answer. We're in serious trouble. I want to look at another bank, Silvergate Bank, the voluntary bank liquidation, $16 billion. Here's a sample out of the Officer of Inspector General's findings. Quote, First, we found that the board and the Federal Reserve Bank of San Francisco considered requiring Silvergate to file an application under Regulation H as it evolved to a novel business model focused on the crypto industry, but did not. The board and FRB San Francisco viewed the bank's activities as traditional banking activities because the bank received cash deposits from and made loans to its crypto industry deposit customers. Regulation H requires state member banks to obtain approval from the board, that's the board of the Federal Reserve, before changing the general character of their business. We believe the boards and the Federal Reserve Bank of San Francisco's narrow interpretation of whether Silvergate's activities constituted a change in the general character or traditional banking activities appears to directly contradict the exception of the board's guidance on Regulation H, contained in the Supervision Regulation Letter 02-9, which is to assess the risk implications of a bank's strategic shift. The board and FRB San Francisco's narrow interpretation allowed Silvergate to enter a new business activity and gradually shift from commercial and mortgage banking activities to operating as a monoline entity serving the crypto industry without obtaining approval or implementing any conditions to address that transition. Second, we found that examiners should have escalated concerns through stronger, earlier, and more decisive supervisory action. While interviewees mentioned that resource constraints hindered their supervisory roles, we believe that examiners should have taken more aggressive and decisive supervisory action to escalate several issues in light of the bank's unchecked growth, its volatile funding and deposit concentrations, and its significant, pervasive, and persistent weaknesses in key control functions. Third, we identified ways in which FRB San Francisco could have strengthened the process to transition Silvergate from the community banking organization portfolio to the regional banking organization portfolio. It continues, in 2021, Silvergate's total assets exceeded $10 billion. As a result, the bank transitioned from the community bank portfolio to the regional bank portfolio in January of 2022. We found that FRB San Francisco could have assigned an RBO team, that's a regional bank organization team, to Silvergate earlier to facilitate the transition. Fourth, we found that the board's examining guidance does not include information that could have helped examiners address the risks associated with Silvergate's business model and deposit composition. Although the guidance addresses liquidity risk and management and risk in rate-sensitive deposit, it does not address deposits that are highly susceptible to flight risk, such as uninsured or non-interest-bearing deposits and deposits that are highly concentrated in one industry. Lastly, we found, it continues, that the board does not have guidance for examiners supervising banks projecting or experiencing significant rapid growth, and does not have guidance on how examiners should assess whether a bank's risk management capabilities and key control functions have evolved with that growth. Examiners did not take sufficient measures to pressure Silvergate to improve its risk management capabilities and key control functions so that it could effectively manage the bank's escalating risk profile. That's all from the review of the supervision of Silvergate Bank, the Officer of Inspector General, 09/27/23. So here's my translation of Silvergate. Silvergate didn't sneak up on anyone. It was under the Federal Reserve Bank of San Francisco since December of 2012, for more than a decade. As noted in the findings, the bank moved its business strategy to a crypto bank and didn't file a required application under Regulation H. The San Francisco Fed did not require the didn't require the application, but should have. A huge miss, seriously. But why? The bank completely became a monoline entity serving the crypto industry without obtaining approval, etc. Was everyone at the San Francisco Fed asleep? The examiners failed to adequately escalate concerns through stronger, earlier, and more decisive supervision action. Who's at fault there? It can't just be the examiner's fault, as they have managers too, right? Resource issues were cited too. Senior management is to be blamed on that one. Examiners were not aggressive and decisive enough to push supervisory action. Again, you can't pin this solely on the examiners. The San Francisco Fed also failed to transition the bank to the regional banking organization in a proper time frame. Senior management owns this one too. The Federal Reserve Board of Governors also was missing guidance for the San Francisco Fed to properly do its job, like how to handle concentrated flight risk deposits, rapid growth, and underlying risk management and key control function guidance. Are we in trouble or what? Finally, the report blames the examiners once again for not taking sufficient measures to pressure the bank to improve its risk management practices. Yes, leave out the examiners' managers, right? Once again, the culture at the Federal Reserve Bank of San Francisco is confirmed to be deficient, in my opinion. It's good to keep pointing upstairs, too. Is the Officer of Inspector General aware of any of this, and why didn't it have it addressed earlier? We're in trouble. This short ad is sponsored by the TunaBudget.com podcast. Hey friends, looking to improve your personal and family financial wellness? Don't miss the Tuna Budget podcast at TunaBudget.com. Download your free Tuna Budget Worksheet Plan, the most powerful budget worksheet plan in the world, yours. In addition, dozens of Tuna Budget's human side candid conversation memos may be the perfect answers you're looking for. Join us for real candid conversations and candid questions that can change your life for the better. Subscribe to the TunaBudget.com podcast and empower yourself to take charge of your future and financial well-being. Hey, I want to talk about another risk for a minute, that of derivatives. I'm not sure if everybody's heard of that. Frankly, I think it's impossible for 99% of us to understand. I don't think I even have a clue what they are, but here goes. It's an interesting article by Caleb Naismith, January 2024. Is $203 trillion in derivatives held by Goldman Sachs, JP Morgan, and other top banks causing an everything bubble? Interesting. He says, the scale of derivatives held by major banks like JP Morgan Chase and Company, Citibank, and Goldman Sachs, amounting to $203 trillion, has raised concerns about the potential risks these positions might hold to the global economy. The third quarterly report on bank trading and derivatives activities, published by the Office of the Comptroller of Currency, it's out of the U.S. Treasury, provides a comprehensive dive into this issue. This figure surpasses the world's gross domestic product by roughly double, highlighting the enormity of the market. It goes on. J.P. Morgan Chase in particular is noted for its substantial exposure to derivative risk, topping the list with roughly $58 trillion in derivatives. The mounting scale of derivatives owned by banks raises several questions and concerns among regulators and investors. A derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity can be an asset, index, or interest rate. I told you we weren't going to understand any of this, but that's fine. Just plow through with me. Derivatives can be used to offset risks in the future or be used to leverage to increase gains or losses. But it's unlikely the banks are the ones holding these derivatives. Rather, many of the top banks act as market makers for entities buying and selling derivatives. While these banks have large derivative positions on their balance sheets, the notional value is a fraction of the total derivatives market. This is because there are typically two sides to every trade, a short and a long. Because each side has a bullish or bearish position, the total size of the derivatives market doesn't necessarily correlate with risk. The banks likely don't hold exposure to most of these individual positions. They are market makers for these transactions and largely facilitate the transaction between the parties. These parties often use the derivatives market to manage risk by hedging their bets or using swaps to limit future exposures. This isn't to say there isn't significant market exposure to derivatives. Keep bearing with me for another minute. This is very interesting. By all metrics, the use of derivatives is increasing. Between the first quarter of 2022 and the third quarter of 2023, the notional amounts of derivatives increased by about $10 trillion. If an entity mismanages its risks and becomes too exposed to derivatives, there could be risks associated with those trades. But regulatory measures like the Dodd-Frank Act and other high capital requirements imposed by the Federal Reserve are regularly used to mitigate such risks. A larger concern is the lack of reporting and availability of data surrounding the derivatives market. Interesting. For example, a recent BIS article highlighted the growing trillions in missing debt created by certain derivatives. Forex swaps, forwards, and currency swaps create debts that don't appear on balance sheets and most debt statistics. Swaps such as these are an underlying common denominator for many financial crises and shocks to the system, causing entities to fail or creating funding squeezes. These off-sheet debts are estimated to be a staggering $97 trillion globally across all currencies and growing fast. The lack of reporting for these debts makes it difficult to predict future recessions and make policy regulating derivatives. Keep going with me. The $203 trillion in derivatives held by major banks underscores a complex financial landscape where the interplay of risk management and market speculation is pivotal. While banks often act as intermediaries rather than principal holders, the sheer size of these positions raises questions about systemic risk and market stability. Regulatory frameworks and reporting standards, although improved, still face challenges in fully capturing the nuances of the derivatives market. The need for enhanced transparency and oversight in the sector remains critical, particularly in light of the growing off-balance sheet debts that continue to elude conventional monitoring mechanisms. When innovative technology and gambling-like risks are combined, that's what I say. Want to play with another iceberg? The banking industry is playing in a game of musical chairs, where the risks become increasingly higher and higher. Even experienced professionals don't understand the risks involved with derivatives. Future contracts on commodities, options tradings on stocks, currency swaps in foreign exchange markets, mortgage-backed securities, interest rate swaps for banks, credit default swaps on bonds, and more. Remember the 2008 financial crisis, where the widespread use of extremely complex financial instruments like derivatives contributed to the severity of the economic downturn? Prior to the Great Recession of 2008, there was a surge in the issuance of collateralized debt obligations, especially those backed by subprime mortgages. These CDOs were designed to pool various debt obligations, including mortgage-backed securities, and create tranches or buckets with different risk profiles. The complexity of the structures, combined with a lack of transparency, no one knows the extent of the risks, and inadequate risk assessment, contributed to the severity of the financial crisis in 2008. That's what helped cause it. The derivatives market poses a significant risk and operates over the counter, or the trades are private and not over centralized exchanges that lack transparency. Derivatives also have the potential for speculation, right? Taking risky bets to maximize short-term gains, as well as having leverage. They control large positions with little money. There's also counterparty risk, the risk that the other party in the transaction will not fulfill its obligation. All this can breed systemic risk, like in the 2008 financial crisis. Oh, but there's more. There's much, much more to be asking ourselves. Due to their size, complexity, and lack of transparency, which should speak for itself, what could possibly go wrong if there were a debt crisis and all those hands go out asking to be repaid when derivative contracts come due? The entire banking system is interconnected, and the banking system risks are interconnected. Don't ever forget the crisis in 2008. Again, what could possibly go wrong in 2025 and thereafter? What does your gut tell you is coming? And nobody will talk about these complex financial arrangements. Why? Because nobody can even go there and think about default conditions, regardless of any red flag conditions, until one day, just like in 2008, the music stops. In conclusion, so what, when, and how does this risk affect you? Here's a question. Can you sleep at night? When you peel back the layers to the U.S. banking system, which you'd expect to be one of the best in the world, from a supervisory perspective, how can anyone sleep at night? It's beyond obvious that we're in big trouble. With all these deficiencies that surface from recent bank failures and a liquidation, it's not that there aren't great employees working there at all. Certainly, these are professionals who know their jobs. It's got to be something else at the supervisor-manager level and above, in my opinion. It's got to be a culture thing, starting at the top. Divergent views are not likely welcome, even though they likely say they are, even expected. Some clients, banks, people are not to be criticized or touched. And that's what's happening in all likelihood, in my opinion. They are likely protected by the top brass. Oh, the stories these examiners could tell, right? But they want to keep their jobs. If these examiners were turned loose to do their jobs with a fair culture, there's no doubt the work would get done, in my opinion. It smacks of being political at the top, doesn't it? If that isn't the case, It's too bad more examiners don't step up and speak their mind. Obviously, they are going to preserve their jobs, but look at what happens when the job doesn't get done. Are we happy with that? No. It is about these agencies not managing their businesses much better than the banks they supervise themselves. If the lines of defense, like auditors and the Office of Inspector General, are not picking up this stuff, what good are they to? Wish ourselves good luck. For good measure, have you ever heard of any banker ever having their massive bonuses clawed back or fined? Same with the supervisors who let the banks get away with these documented failures. Competent regulatory oversight? To me, again, it seems like the regulatory agencies may not be hitting on all cylinders. Are they really prepared to do the job today before these banking risks get out of hand? Clearly, by their own findings and conclusions, they were not sufficiently prepared and failed themselves in large part at adequately supervising these failed institutions before they failed in early 2023. That inspires confidence, right? No, not at all. We're in trouble, folks. You don't change blind and incompetent supervision cultures overnight either. And it's getting plenty dark and scary out there. Most people will ever know these risks even exist. Meanwhile, untold trillions of dollars in deals are subjected to derivative risks in the marketplace. The entire derivative market has potential risks, their complexity, lack of transparency, potential for speculation, leverage concerns, concentration risk, counterparty risk, historical precedent, and delayed crisis recognition, think 2008, regulatory challenges, all the gaps. In particular, the lack of transparency leads to possible market manipulation, insufficient price discovery, inadequate risk assessments, increased systemic risk, limited accountability, reduced investor confidence, ineffective regulatory oversight, inequality to access to information. There's unfair advantages, distortion in market competition, and difficulty in implementing effective policies. Also keep in mind that banks are interconnected through interbank lending, derivatives, and counterparty risk. Some banks have high levels of leverage, their debt-to-equity ratio, hold derivative contracts, not just serve as an intermediary, have credit concentrations, and are subject to interest rate risk, their sudden and sharp increases. External global economic shocks, and of course, cybersecurity threats. Don't forget there's the global, less transparent shadow banking system of non-banks that operate completely outside the regular banking system, and whose assets are estimated to be in the trillions. It includes hedge funds, money market funds, securitization activities where they bundle financial assets like mortgages into securities and sold to investors, and repurchase agreements. Unlike regular banks, these entities face fewer regulatory constraints, means they're higher risk. So hold on, folks. The banking system and marketplace is still at risk. Interest rates will be high and likely to be triggered even higher for any number of reasons. Inflation can be triggered from the 20 or so risk events outlined in the debt crisis problem at any time. What are the chances these risks won't trigger more U.S. government spending, higher inflation, and higher interest rates to combat these things? Seriously, with these risks and how fragile everything is these days, what might the outlook have in store for the banking industry? I believe that after the bank run failures of some banks early in 2023, high interest rates will continue to plague banks with their embedded losses on securities they hold. They will eventually have to pay the high interest on their deposits, higher interest on their deposits for customers so they don't pull out those deposits. So-called sticky deposits are going to become more slippery. Call it deposit flight. And money will quickly move out of some banks with all the online tools that are currently in place. This will create an environment of more downward pressure on earnings for some banks and lead to more bank runs on others in the near term. So we're still here, still in it. Many banks will quietly raise their hands looking to sell. Commercial real estate loans, especially office space, will continue to come more into focus too, as such loans will experience higher interest carry costs when, and if they can, they are refinanced at higher interest rates, as well as increased operating expenses over the near term. Capitalization rates will increase, and values will continue to be reduced, thus fueling vicious downward spiral cycles. Even heretofore safe bubble markets like those in Hawaii will not escape these risks and will also finally be materially impacted, in my opinion. For so many years, Hawaii's been an anomaly, but I don't think it's going to last forever. Credit repayment risk will increase for regular commercial loans, but especially the CRE office market, where billions in loans are underwater. Such loans are subject to refinance risk at much higher interest rates while experiencing high vacancy rates due to remote workers not being in the office. Pricing for risk in a higher refinance market interest rate environment will further expose banks to potential impairments or losses, kiss their dividends goodbye, and downward pressure on bank stock valuations. Banks will begin to sell CRE secured debt at discounts, demonstrating their own lack of faith in the CRE market. The higher the interest rates, the lower the collateral property values, and the higher repayment default risk. And the regulatory agencies will sharpen their pencils to ensure prudent credit risk management practices are accounting for all of this action. All these forces will likely create a wave of merger and acquisition deals for acquiring banks to survive. Lastly, more banks will fail due to portfolios of defaulted commercial real estate loans, with their embedded losses in other loans and security portfolios, which are currently at low interest rates. Such asset sales would be needed to cover fleeting deposits. Who knows what will happen once the ball gets rolling? And at what cost for all this mess? And what is the cost? Can you smell a debt crisis yet? Thank you for joining us. Today we explored the banking system, a major risk contributing to the looming debt crisis. We hope to highlight the urgent need for transparency around these risks. We want to hear from you. Submit your own debt crisis memo and share your thoughts at tunabudget.com. If you found today's episode valuable, please subscribe for future podcasts. Your support helps us grow this healthy debate. Until next time, take all necessary precautions. Your financial wellness matters. Thanks again.